Does the Market Overreact was one of the first investing papers that I ever read. It was written by Werner de Bont and Richard Thaler, and the paper essentially came to the conclusion that markets discount future expected earnings. If those earnings come to fruition, share price would stay quite elevated, and if the earnings didn't come to fruition, we would correct lower. So it was all about discounting future earnings. I then started to screen out companies looking for growth in earnings, looking for price to earnings to come down significantly, the multiple, while EPS was growing at a fast pace. A company that screened out in 2015 was Amazon, and Amazon was going from 1,000 PE down to 300 PE. I ultimately came to the conclusion that the company was too expensive. Since 2015, the share price is up over 500%, and despite a recent 50% decline in the share price, if I had bought it back in 2015, I still would have compounded at 30% per year. So what was I missing? Clearly, I misunderstood what the company was doing. But over the years, I figured out that if I was closely watching working capital, I'd be able to better understand the opportunity that was occurring beneath the surface. So in today's video, we're going to discuss working capital, what it tells us about the future prospects of a business, about those future potential growth, in conjunction with growth in shareholder equity. Let's get straight into it. For this example, we're going to be using Ticker Terminal. Everything we need here is on Ticker Terminal. There's no need for a whiteboard. So if you guys are interested in using Ticker Terminal software, there is a link in the description. I'd really appreciate if you used our link. Okay, let's have a look at what working capital is to begin with. And we're also going to marry this into the growth in book value. The book value of shareholder equity. That's the net worth of the business. And you'll understand why in just a moment. So we're going to use Amazon. We clicked into Amazon. We've gone over to financials. We're looking at the balance sheet. What's working capital? Well, working capital is taking our current assets. Now, if you haven't seen the balance sheet update, you don't know the difference between total assets and current assets, it's very simple. It's assets that are cash, near cash, are going to convert to cash inside the next 12 months. But we do have a deeper dive into the balance sheet. I'll leave a link just above. So it's taking current assets and it's minusing out current liabilities. Very simple, but it gives us an incredible amount of information about the business. So that's what our working capital is. And if we pop on over to our cash flow statement, and we mentioned this when we're analyzing the cash flow statement, it's very important to keep an eye on working capital. Working capital, if working capital is breaking down or it's diminishing, what essentially does that mean? Well, let's have a look at those current assets really quickly. We've got cash, short-term investments, we've got accounts receivable. What are accounts receivable? We sold a product, issued a receipt, we're now expecting to be paid, or issued an invoice, we're now expecting to be paid. We haven't been paid yet. So it's sort of like a gauge of business activity, inventory levels, restricted cash, other different metrics. But more importantly, cash and receivables are very important. What we're saying is the working capital is going down, it means that either liabilities are growing at a faster pace than assets, short-term assets, or assets are diminishing at a faster pace than short-term liabilities. And the reason why that's a problem is when we look at those short-term liabilities, the current liabilities, this includes accounts payable, accrued expenses. We might be purchasing more than what we're selling. We might be bloating our inventory. We might have a lot of challenges. We might be issuing too much short-term debt. And that's ultimately what's been the case here. If you have a look at Amazon in the past 12 months, they've issued $12.8 billion in short-term debt. And we'll see now in a moment how that impacts their working capital. So when we look at the cash flow statement, cash from operations, we can see the change in net working capital. Very important because that can give us an idea of the financing of the business in the short term. In the last 12 months, we've seen it diminish 21 billion, and a lot of that has likely got to do with $12 billion increase in short-term, partly got to do with a $12.8 billion increase in short-term borrowings. However, we're here to look at Amazon back in 2015. I never bought the company because I felt it was too expensive. So let's have a look at working capital, the changes in working capital right into 2015. Well, we've seen working capital continue to grow year in, year out. Working capital was growing. What does that mean? Liquid assets are growing at a faster pace than short-term liabilities. What does that mean? Well, maybe business is growing at a faster pace. Why? Well, maybe what we're seeing is more accounts receivable. We're seeing the receivables increase. We've sold more goods. We're waiting for our customers to pay us. Business is booming. Or we're converting an awful lot more to cash. Or the asset turnover ratio is very high. The equity turnover ratio is very high. Inventory turnover ratio is very high. All very, very, very positive signs for a business. So the increase in working capital is a sign that assets are growing at a faster pace, or we're expecting that to continue into the future. So in 2015, when the company has a PE of 1,000, that's expected to decline down to 300, then down to 200 in fiscal year 1 and fiscal year 2. I look at that and I said, that's too expensive for me. Here's what I missed though, and I didn't figure it out until a couple of years later, and it helped me look at businesses a little bit different. So these are very simple metrics, but they tell us an awful lot about the business. So let's have a look at shareholder equity. Throughout that time, what were we saying? Working capital continued to grow. The change in working capital was always positive into 2015. Multiple, way too expensive, and that was the deal breaker for me. But it was a major mistake, major mistake. As I mentioned in the intro, the compounded growth rate since 2015 up until the present day has been 30%, despite a 50% drawdown off all-time highs. That's impressive. If we scroll down here and we have a look at total equity, and let's have a look at total equity since it turned positive in 2005 into 2015. So in 2005 we started to see positive shareholder equity. All the way into 2015 we've seen consistent growth. Now let's pull up a calculator and we're going to calculate the compounded growth rate of shareholder equity over that period. It was an expensive business, but how fast was it growing? How fast was the book value of shareholder equity growing at that point? So in order to calculate that, we're going to open our brackets. We're going to take 2015's total equity, which is 13,384, and we're going to divide that by 2005's, which is 248. And what we're going to do is we're going to put that to the power of, open our brackets one more time, 1 divided by the number of years. So we've got 2005, 6, 7, 8, 9. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 years. By 11, close brackets, minus 1 equals the compounded growth rate since 2005 into 2015 for shareholder equity was 43.7%. The shareholder equity was growing at a ridiculous pace even before they had earnings. Right? So earnings were only positive for the first year in 2015, and that's why the multiple was so high. But how we could have analyzed this business is by looking at the growth and economic value of its shareholders. And that was the part that I missed. So some companies that may be unprofitable, if they have enough liquidity on their balance sheet in order to get through the next couple of quarters until they get to profitability, and we can analyze the change in net working capital plus the growth in shareholder equity, it'll give us an idea of the economic value per share that we're receiving, the growth per share that we're receiving every single year. And in this case with Amazon, it was 43.7%. And that was a very simple way of looking at it, but it would have changed my view on the business significantly back in 2015 if I had focused more so on working capital, the changes in working capital, how that impacted the total equity and the compounded growth rate of the book value of shareholder equity. The book value, the company's net worth, was growing at 43.8% year on year. And since 2015, we've seen something similar in and around 40%. If we look at the growth since 2015 into the present day, and we're going to do exactly the same calculation. So we pull up our calculator. We've got the present day. Well, this is 2021. We've got 138,245. And we're going to, sorry, this should be in brackets. Open our brackets. 138,245 divided by 13,384. And we want to put that to the power of, open brackets, 1 divided by, how many years? 1, 2, 3, 4, 5, 6, 7. And we're going to minus 1. And the compounded growth rate of the shareholder equity since 2015 has been 39.6%. Compounded growth rate of shareholder equity. The equity itself, the underlying equity today, after a 50% decline, has grown something very similar. it's grown at 30%. It's up in excess of 500% since 2015, and it continues to grow at such a fantastic clip, despite having a price to earnings at 65 today. So that's something that's really important to keep an eye on. When you're looking at a business, if the business is maybe a high multiple, it doesn't necessarily mean that you're not getting economic value. It's not always just about price to earnings, enterprise value to EBITDA. It's about the economic value that we receive for investing in an individual business. If you're interested, we also cover a breakdown of all 3 financial statements. We look at profitability metrics and efficiency metrics for businesses. Thank you very much for your support and have a great day.